Hello, we are back, aren't we? Okay, and we are in chapter 5, right? And we have been talking about from chapter 1 to chapter 4. We'll just do a little review real quick. Going to the computer. In chapters 1 through 4, we were talking about service companies, weren't we? People who sold their services. They basically sold their time. And we talked about the net income equation for that, right? But what this chapter is, this is talking about retailers or merchandisers, right? And retailers and merchandisers, they purchase items from manufacturers and then sell them to the public, right? So they have the purchase cycle, they have the sales cycle, okay? And their net income equation looks a little different, okay? It looks like that, and their inventory flow equation looks like that. Using the more, I think the easier way to look at these things, we went over these equations, didn't we? Okay, we did some examples in class. And as a matter of fact, the class just took a quiz over this information. And that quiz is right here, okay? So I just picked that up. What I would encourage you to do, folks at home, my online students, is just to pause this video and see if you can do this quiz. You know, just on a separate sheet of paper. Obviously, I can't grade it. Obviously, I can't collect it. But just go ahead and take this quiz real quick. And then when we go over the answers, you can see how you performed. All right? All right, let's go over the answers to that quiz here. And I have, I believe, the answers right here. Okay? There are the forms of the equation. And there are the answers. Now, the answers, the numbers that are highlighted in yellow were answers on your sheet, but they're probably in a different order than what I asked them, aren't they? Okay? So make sure you're aware of that. Okay? Sometimes I won't ask things in the order that you necessarily computed them. Okay? Did anybody get all 5 of those answers right? Okay? Good job. Good job. Any questions on that? Did I give you some stuff that you didn't need at all?
Yes.
Yeah. Okay. If it's not in the equation, don't try to force it into there. Okay? Questions? All right. Good job. Okay. Let's start lecturing. And I know I had a couple of things I wanted you to do for homework. We'll go over those eventually. But what I want to do is go back to chapter 5 and a little bit more review, and then let's lecture on the purchase cycle, okay? Let's go back to this slide right here, okay? Now, as I said, we are talking about retailers or merchandisers here, okay? These are companies, they don't manufacture the goods that they sell, but they purchase from manufacturers and then they sell them to us, okay? So take an example of a retailer or a merchandiser like JCPenney, okay? What they do is they do a lot of purchasing of inventory, don't they? Okay? From all these different clothes manufacturers everywhere, correct? And then they sell those to the customer, okay? So there's 2 cycles here. There's the purchase cycle and there's the sales cycle. Now, of course, I want to make sure you are firmly shifted into the right gear here. You are looking at all this from the perspective of the merchandiser, of the retailer, of JCPenney, okay? Not of the ultimate customer, not of the manufacturer of these clothes, but of the merchandiser or retailer, okay? But what we're going to talk about today is the purchase cycle. And in the next class period, we'll talk about the sales cycle, okay? All right, let's go to the purchase cycle. Let's start looking at some journal entries for the purchase cycle, okay? On June 20, Jason Inc., that's us, we purchased $14,000 of merchandise inventory paying cash. So we're the retailer here, we're the merchandiser. We purchased $14,000 of merchandise inventory from our manufacturer. Eventually, we're going to sell that to our customers, but that's not today. That's next period. So the journal entry we make is this right here. We debit merchandise inventory for $14,000. That's an asset. That's a current asset. Okay? And we credit cash because we paid in cash this time. Okay? Now, this is kind of a new account, merchandise inventory. And I want you to call it, don't just call it inventory. I want you to call it merchandise inventory. Because for a retailer, merchandise inventory is a very specific asset where we keep track of the inventory we purchased as a merchandiser that we're eventually going to hopefully sell. You with me? So we debit merchandise inventory, we credit cash. That's not too hard, is it? Okay. Now, let's talk about trade discounts. Okay. Trade discounts, what are those? Well, those are used by manufacturers to encourage us to buy in larger quantities. Okay, you can come off that. Okay. Can you see why if you're a manufacturer and you are selling, you'd rather have one person order or one company order 500 of an item than have 5 separate orders that you have to process of 100 items each, right? Okay, for a number of reasons. So a trade discount is an incentive to purchase in larger quantities. And you guys deal with this all the time, right? If you go to Walmart and you want to buy just one tube of toothpaste, maybe it'll cost $3. But if they have a pack of 3, and if you buy it, it's a total of $6, so it's $2 each, right? Okay. Or if you buy the big box of Cheerios, the amount that you pay per ounce is less than if you buy the small box of Cheerios, right? So we see this all the time, okay? And this example is the same. So let's take a look back at the computer and look at this. Matrix Inc., that's where we're purchasing from. They offer a 30% trade discount on orders of 1,000 units or more of their popular product, Racer, okay? Each Racer has a list price of $5.25. Now, first of all, keep in mind this. When you go buy products, you probably just buy one of them, right? But when a merchandiser or a retailer, such as JCPenney or Best Buy, when they purchase items, they're going to purchase a lot of them, right? Because they're stocking their shelves, stocking their retail shelves, okay? So this is how this looks. Okay. Quantity sold, let's say we're going to order 1,000 of these. Now, if there were no discount at all, we would be paying $5.25 each, and we would owe a total of $52.50 for those 1,000 items, correct? However, they offer a 30% trade discount on 1,000 or more, and we purchased 1,000. So what is 30% of $52.50? Well, it's negative, or it's $1,575. So after the discount, our invoice price is only $36.75. You with me? But that is a trade discount, and that is to incent us to purchase in larger quantities, okay? Now, let's take a look at an invoice. You guys have all seen invoices before, right? If you go buy a computer at Best Buy, they'll give you an invoice, okay? Let's take a look at some of these. Number 1 is the seller or where you bought it from. Number 2 is the invoice date and the invoice number, usually listed up there, 2 and 4. This is whoever purchased it, right? The buyer, okay? Now, down here is the details of what was purchased. Now, what was purchased? A 250 backup system. Now, remember, this is a merchandiser. They're going to purchase a lot of these. In this case, they purchased 500 of these to eventually sell to the end customer, correct? These things cost $54 each, so 500 times 54 equals $27,000. That's the amount that's due, okay? And there's usually an item number attached to that, so it's easier when we order it to look it up by the exact item number so you know you're getting the exact right thing, okay? Now, this right here, number 6, it talks about how it's going to be shipped. And then this is real important. Number 5 is credit terms. Well, what are the credit terms on this example? The credit terms are something called 2/10 in/30. What the heck does that mean? Well, what that means is this. That means we owe the full amount due in 30 days. Okay, we have to pay the full amount by 30 days. However, if we pay within the first 10 days, if we pay by day 10 or earlier, we can knock off 2% on what we owe. Are you with me? Let's go back and look at it on the invoice. There's the shipping terms right there. Now this says we owe $27,000. We have to make sure, if nothing else, we pay by day 30. However, if we pay within 10 days or earlier of the invoice date, we can knock off 2% of what we owe. You with me? Okay. And there's other ways that that can be stated. Okay. For example, you could have 310 in 60, which means that you owe the full amount in 60 days, but if you pay within 10 days, you can knock off 3% of what you owe, right? Or you could have 115 in 90. You got to pay within 90 days the full amount, but if you pay within 1 day or pay within 15 days, you can knock off 1%, right? Sometimes they'll just list their payment terms like this, their credit terms like this, in 30. That means there's no discount for paying early. You got to pay by the 30th day. Or sometimes you'll see something like this, 210 in EOM. What does EOM stand for? End of month, which means you need to pay the full amount by the end of the month. However, if you pay within the next 10 days, you can knock off 2% of what you owe. Make sense? Questions on that? Okay. Now, let's take a look at how that actually works. Okay, on May 7th, Jason Inc., that's us, we purchased $27,000 of merchandise on account. The credit terms are 210 net 30. So our journal entry that we make on May 7th is right there. Okay? This is on May the 7th. Now, we debit merchandise inventory for $27,000. We credit accounts payable for $27,000. The terms credit-wise are 210 net 30. So we owe the full amount in 30 days. However, if we pay within 10 days, we can knock off 2% of what we owe. Now, this is a May 7th situation, right? So what day do we have to pay by to get that discount? May 17th or earlier, and we can take that 2% discount, right? Well, we pay it on May 15th. We pay it on May 15th. This is how I think about it. Well, we don't have to give them $27,000 of cash. We only have to give them 98% of $27,000, which is the 100% minus the 2% discount. So we only have to give them $26,460 of cash, right? Yet we're going to debit or decrease the accounts payable for the full $27,000. Okay? We don't debit AP for $26,460. And the reason is, let's look at the accounts payable T account right here. We originally credited $27,000 of accounts payable, right? If we debited it incorrectly for $26,460, it would imply we still owed them money, but we don't. So we debit the accounts payable for the full $27,000 to reflect that we don't owe them anything, okay? So we only had to pay cash at $26,460. We decrease the entire accounts payable. It's all satisfied now. Well, where does that other $540 go, which is the 2% of the $27,000? That goes towards merchandise inventory account, that asset. Sometimes this strikes people as odd. It's like, really? You credit merchandise inventory for $540? Why are you doing that? You're not getting rid of or returning inventory or anything. Why would you decrease your inventory? Well, the reason we do it is this. We originally debited, now let's look over here at the merchandise inventory. we originally debited merchandise inventory for $27,000, right? But that's not what we paid for it. So that right there is a violation of the cost principle. Because if we didn't do anything or we didn't do it like that, we would have recorded merchandise inventory at $27,000, which is more than what we paid for it. How much did we pay for it? $26,460. So by us crediting merchandise inventory for that $540, our inventory will be recorded at the true cost of what we paid for it. Are you with me? Okay? So that's why we do that, to follow the cost principle, or sometimes called the historical cost principle. Cool? Okay, let's switch over. I think I had you do a couple quick studies, didn't I? Okay, and the two quick studies I had you do were, I believe, Quick Study 5.6 and Quick Study 5.7. Is that correct?
Yes.
Okay, let's go over the answers to these two. All right, let's go over those. All right, I actually want to do Quick Study 5.7 first. Quick Study 5.7, okay? So let's do that. Quick Study 5.7, prepare journal entries to record each of the following transactions. The company records purchases using the gross method and the perpetual inventory system. Okay, on September 15th, we purchased merchandise with an invoice price of $35,000 and credit terms of 2/5 in 15. Okay? Well, let's take a look there. Is that the journal entry that you got? Debit merchandise inventory, credit AP for 35 grand. Is that what you got? Okay. The credit terms were what? They were new. We had never heard those before. 2/5 in 15. Is that right? Is that right?
Yeah.
Yes, okay. So it's 2/5 in 15. So what day do we have to pay by to get the discount?
20th.
The 20th, right? 5 days on after September 15th is the 20th. Well, what day do we actually pay? September 29th. So we missed the discount period, right? Wah, wah, wah. Okay? So we have to pay the full 35. Sorry. No discounts for you. We pay the full 35,000. And the whole AP goes away. Cool? That's for a discount missed. Now let's read Quick Study 5.6. On August the 1st, we purchased merchandise with an invoice price of $60,000 and credit terms of $310 net 30. So that would look like this, right? Debit merchandise inventory, credit AP for $60,000, right? And our credit terms are $310 net 30. Is that correct? Yes. Yeah? Okay, so what day do we have to pay by to get that discount?
August 11th.
August 11th. And what day do we pay? We pay on August 11th, so we get the discount. So we don't have to give them cash of $60,000. We give them cash of 97% because it's $310, right? So our cash is credited for $58,200, which is 97% of $60,000. Now we debit AP for 60 grand. It goes away. We're satisfied. We've satisfied that liability. And then that difference, that 3% of 60,000 or 1,800, goes towards reducing merchandise inventory to the true amount that we paid for it. Cool? Okay. Questions on that? You guys are really quiet today. There's no questions? Nothing? No? No questions? Okay. All right, well, let's move on then. One thing I want to address is this, is when we don't take these discounts, is it expensive? Yes, it is. Okay, and you might say, oh, lighten up, Krug. It's not that expensive. It's only, 2%. That's not much. Well, here's the deal. Let's take credit terms of 210 net 30, for example. Okay? Credit terms of 210 net 30. Okay, now you can pay, this is today, this is 30 days from now, right? You can pay right here 10 days from now and still take that discount, correct? Right? So, but if you choose not to do that, you have to pay by day 30, right? So if you choose not to take the 2% discount, how many more days do you get before you have to pay? Huh? 20, right? You get this extra 20 days. So, now we're used to thinking of percentages and interest rates in annual terms, aren't we? But this isn't a 2% cost if you choose not to take the discount. This is 2% for 20 more days. Okay? So if you really wanted to know the annual cost of what it means to you when you miss these discounts, what you need to do is say, okay, in 365 days in 1 year, how many 20-day periods are there? And you take that times 2%, and you get something like 36.5% annual rate. Okay? And they show that on the computer here, right? This is the true annual percentage rate cost of if you miss that discount. You with me? Now, if I had a company and then we owed a mortgage on our building, and Jacob, I asked you to go to the bank and renegotiate our mortgage that we owe, and you came back and said that you did it, and you got it at a fixed annual rate of 36.5% cost, would I be happy with you? Not at all, right? That's expensive. Well, when you miss discounts, you're essentially financing your inventory, if it's these terms, 210 net 30. When you miss the discount period and don't take that 2% off in this case, you're essentially financing your inventory at 36.5%, which is not smart, is it? Follow me? Okay. As a matter of fact, you'd be better off to pay it on a credit card than to miss that discount. By the way, do you know the main reason that most companies, and one of the things I do is when I go into my clients, I'll look and see if they're meeting their discounts, if they're paying within that discount period and getting to enjoy the discount. And sometimes they're not. Most of the times they are, but sometimes they're not. They're not making payments within the discount period. Do you know what oftentimes the reason they're not enjoying those discounts and they're not paying within that discount period is? It's not lack of money. They have the cash to pay. But do you know what sometimes the main reason is that they're missing those discount periods? Anybody venture a guess?
Yes.
What?
Laziness.
Laziness is a harsh term.
They're lazy.
Okay?
Procrastinating.
That's probably more accurate. What were you going to say, Nathan?
Like I said, I couldn't think of the word, which was procrastinating, but
Okay, let
lack
me
of
ask you this.
organization.
Let me ask you this. Do you ever have any classes at JCCC, and you guys are actually pretty good being on time for this class because of the cameras, I have incentives for you to be on time, right? But think of some other classes at JCCC. Do you have any students that habitually are 5 or 6 minutes late? And you could almost set your watch by them. That 5 or 6 minutes, the door's going to open and they're going to be, they come in, they sneak in, and they go, sorry, the traffic, the parking was crazy. It's like, well, we're all dealing with the same parking lot you are, right? But do you have that sort of person? Or do you have a friend that you know that if you are all going to meet at Applebee's for dinner at 6 o'clock, do you know that your friend is not going to be there till 6:15? Do we know those people? Well, those people work at companies. And sometimes a common reason for missing that discount period is it's not so much laziness, it's not so much procrastination, it's just that they're always a little late. They're always just a little late. Are you with me? And so they end up paying on the 12th day or the 13th day, which is even crazier. If you miss the discount period, you might as well wait till day 30. Am I registering with you? This is good real life stuff that I'm telling you, okay? Let me ask you this. When I was in college, this started to occur. Maybe it's starting to occur for you. Are you guys starting to get credit card applications in the mail? Okay? When I was at K-State way back, I bet you, I'm not exaggerating, I bet I got 3 or 4 of these a week. I could have wallpapered my room in credit card applications, right? There's a lot of people who want you to get their credit card. Now, people who loan you money, and there are times that you do have to borrow money, okay? But people who loan you money sometimes want you to be ignorant. They don't want you to understand. You following me? Let me tell you a trick that they used to do in the 80s and 90s, okay, to try to get you to accept their credit card, okay, is they would send you an envelope, and there would be the stamp, and it would say, new credit card offer. Happy face, right? And it would say, interest rate of only 3%. Wow. Okay? But then they would have a little asterisk that said 3% per month. Well, somebody who doesn't understand things very well might go, 3%? I don't know much, but that's pretty low, right? Is it 3% annually? No, it's 3% per month. 3 times 12 months is 36%, right? It's not a good deal, is it? Okay? But they don't want you to understand that. So they'll say, we love you. You deserve this, right? And they'll say, purchase a new car. People are laughing at you in your old car, right? You'll never find a girlfriend with the clothes you're wearing. You need to purchase new clothes on our credit card, right? They don't want you to understand the true cost of this. You follow me? This is good real life stuff. So you want to be very, very wary, okay? It's the same way with businesses, okay? Know the true cost of these discounts if you miss them. And if you miss them, it's expensive. Cool? Questions? Questions? All right. Let's talk about purchase returns and allowances. Purchase returns and allowances. These actually are similar, but they're different. When we account for them with journal entries, they actually look really similar, but again, they're different. Purchase return. Okay? This is when we purchase merchandise, and for whatever reason, we don't want it, we don't like it, we return it to the supplier. Okay, you can come off there. We've all done this in real life, right? You buy a new outfit or a new jacket or something, and you go home and your family goes, you don't look very good in that. And you go, okay, well, I'll take it back, and you get your money back, right? And usually you buy things with cash, right? But it's the same way with a merchandiser or retailer. If they buy some items and they get it and they go, well, these really weren't what we wanted, they can return it to the manufacturer. Now, chances are they haven't paid yet. So they don't get cash back, they just reduce their accounts payable. You with me? That's a purchase return. The key is that the item actually is returned to the manufacturer, to the original seller. You with me? Now, let's contrast that with a purchase allowance. A purchase allowance is a reduction in the cost of defective merchandise received by a purchaser from a supplier. So let me give you an example of that. Okay, let's say you're an office retailer, okay? And these tables you're sitting at, okay? Let's say that you purchase 10 of these tables for resale. They'll be in your merchandise inventory. Let's say you purchase 10 of these for $40 each, and you're going to sell them for like $70 to the end customer, right? So you purchase 10 of these tables for $40 each. So you owe what? 10 times 40 equals 400, right? Okay. So let's say that you unload these tables, and one of them you see has a scratch, like a 12-inch scratch on it. Okay? And you're like, well, doggone it. So you might call up the manufacturer, and here's how the conversation might go. Oh, I apologize that one of those items was damaged. Here, we'll give you a choice. If you want to return the table to us, we will knock off $40 from what you owe us. Okay, that's a purchase return. Or if you want, keep the table. We'll knock off $25 of what you owe, so you essentially are purchasing that table for $15. You follow me? And some companies might say, well, let's just do that. Yeah, we'll go the purchase allowance method. We'll keep the item, just knock off $25 of what we owe, and essentially we're buying it for $15. You with me? And why might a company do that?
Less hassle.
They can,
Less hassle, Nathan.
they can still sell it for 50 and just put like a clearance
Yeah.
sticker on it, and they'll probably make more money off of it.
Yeah, they might be able to sell it and make just as much money on it because it's a reduced price, but it's a reduced cost. And they don't have to go to the trouble of returning it. Less hassle, okay? I can remember when I bought a new washer and dryer years ago for my family. We went to this one place, and the clothes washer was, oh, I don't know, it was like $500 for a clothes washer, okay? Well, there was one that was a little cheaper. It was like $340. It was the same thing. It had never been used. $340. I said, why is this one cheaper? And they said, look on the side of it. I looked on the side of it, and there was a scratch. It was like this long. When they were unloading it, I think with their utility knife, they went right through the cardboard and just scratched it. Didn't hurt the thing at all. There's just a scratch on it. And I said, giddy up, I'll buy that one, right? I don't care if there's a scratch on the side of my clothes washer. When you go to your friend's house, do you ever look at the size of their clothes washers to judge them? No. Who cares, right? Anybody enjoy buying stuff like that? Okay. Yeah, I always feel like I have a deal. So that's that sort of a situation. Nathan.
So I have a question of what this would fall into, because I do some purchasing with my work.
Yeah.
So like we deal with a lot of like fresh produce ordering, and I've had it one time where they'll give me like a 35-pound bag of onions, and I can't use half of them. So we call them up, and they tell us, just throw out the whole bag. We'll bring you a new one tomorrow.
Yeah.
Would that go under either of those, or?
Well, that would probably be a return, even though you're just throwing it away. Food's a little different.
Yeah, because that's what I think, because we can't directly return it to them. They tell us, just throw it in your dumpster, and we'll bring you a new one.
Yeah, because it's a little different with a scratch table than, let's say you buy a big bottle of peaches, and they're all moldy. I'll tell you what, I'll give those peaches to you for half price. How's that sound? Okay, well, no, I don't want the peaches.
Well,
okay,
it's like
and it's like, why return them? Just throw them away. Nobody's going to want them. Yeah. So that food is, this happens in food.
Because if half a bag's bad, we can still salvage the good onions, and
yeah.
So we always end up with excess in our inventory systems.
It's handled differently, but this does come up in food. Matter of fact, there used to be a place, I grew up in Wichita, Kansas, and there used to be a grocery store where all of their items, if you went to the cereal box aisle, like they all had dented corners and everything. The whole store was cheap food because it was kind of scratch and dent sort of thing. You know what I'm saying? So yeah, you see that. But there are some items that, like again, if you picked up a thing of dinner rolls, 16 dinner rolls, and 5 of them were moldy, you're probably going to throw them all away, right? You're not going to go, well, these look okay, right? These look okay. Okay, unless you're desperate, okay? Make sense? I think you guys get the idea. Let's take a look how this would be accounted for. All right, on May 9 Matrix, that's us, we purchased $20,000 of merchandise inventory on account. Credit terms are 210 net 30. So we debit merchandise inventory, we credit AP for 20 grand, correct? Okay, this is on May 9th. By the way, if it's 210 net 30, what day do we have to pay by to enjoy that discount?
May 19th.
The 19th, keep that in mind. Okay, but what happens on the 10th? We return $500 of defective merchandise to the supplier. Now we haven't paid yet, so we decrease merchandise inventory and we decrease our accounts payable to them, okay? So we owed $20,000 at one point, right? But we decreased it by $500. So what do we owe at this point? $19,500? Okay. We pay within the discount period. We pay on May 18th. So one of the things they're saying is, okay, now keep in mind, you're not going to take the 2% discount on $20,000 because you return $500 of it. You take your 2% discount on the amount that you truly owe. And at this point, it's $19,500, right? So we pay 98% of $19,500, which is the 100% minus the 2% discount, which is we pay cash in $19,110. The entire accounts payable is debited or decreased, and the difference goes towards reducing merchandise inventory. So it will be listed at what we truly paid for it, the true historical cost. Cool? Okay. Couple of other things. Let's talk about transportation. Okay. Transportation. Okay. Come off that for a second. At any given point, you might be driving around town and you see big trucks or trains and they are transporting goods, right? Now, some retailers or merchandisers are having goods transported to them from manufacturers. Some are having products shipped or, when we say shipped, we don't just mean the whoo-hoo ship. We mean trucks, trains, ships, right? So you might see goods being delivered to end customers, okay? Well, one question is who pays for that transportation? Another question might be, who actually owns those goods while they're being transported? Who owns those? Okay. Well, I like to answer those two questions in conjunction with each other because I'll tell you this. Whoever is paying for the transportation is the company that owns them while they're being transported. Now, sometimes the buyer pays, sometimes the seller pays. But while they're being transported, who owns them? Whoever's paying for the transportation. Okay? Now, they kind of do this strange, but here is the shipping point with the seller. Think if they have a loading dock right here. The truck pulls up, gets the goods, and then drives them to the destination, and they have a loading dock right here. Okay? We're always looking from the buyer's perspective. If it's FOB shipping point, that means free on board. If it's free on board only up to this point, then the buyer pays for transportation, and they own it while it's being transported. So if the credit terms you see on the invoice are free on board shipping point, the transportation costs are paid by the buyer, and that's who owns the goods. Now, from the buyer's perspective, if it's FOB destination, it's free on board, clear to the destination. Well, the destination is the buyer's loading dock, right? So it's free on board for the buyer, clear up to here. So while it's being transported, the seller owns the goods because they're paying for the transportation. Are you with me? Colton.
This is just like a random question about like UPS or FedEx. Do you think that for any given company, I guess, that they would set like a flat rate that they would pay for their goods to be transported?
Sure, they do that. There's all sorts of negotiations with
Yeah, like-
transportation.
Just a deal that they would make
There's
with
all sorts of goods. And of course, there's companies that say we offer free shipping, but then they just adjust their price upward, right? Okay. You guys are more adept at this than you think because you use like Amazon, right? Okay. And sometimes an item will be cheaper, but it's when you add the shipping in, it's actually more expensive. So you might pay more for an item because it's free shipping than another seller, right? Okay. So this is important. How do we account for this? Well, this is important, and this is something that students often get incorrect. So let's take a look at it real quick. Okay, on May 12, Jason Inc., that's us, we purchase $8,000 of merchandise inventory for cash, and we also pay $100 transportation costs. Now, the journal entry that we do is this one right here. We pay cash of $8,100. We credit cash for $8,100. Now, here's what a lot of students do incorrectly, is they debit merchandise inventory for $8,000, and then they debit something like transportation expense for $100. But we don't do that. We debit merchandise inventory for the $8,100. We want to capture the true cost of acquiring that merchandise inventory into the asset itself. Are you with me? And the reason we do that is if you didn't do that, it could lead to a bad decision. Okay, if you weren't aware of what your true cost was. For example, let me give you this one real quick. Let's say we are a piano retailer, okay? Now we can buy our piano from, we're in Kansas City, we can buy it from Liberty, Missouri, which is pretty close by, and the price of one piano is $600, and the shipping is free, okay? Or we could buy it from St. Louis, which is about 4 hours away. Now the price of the piano is only $560, but the shipping, since it's farther away, costs $80. Well, where are you going to buy from? Where are you going to buy your piano from? Liberty or St. Louis? Liberty. And if you kept track of that shipping expense or transportation expense separately, you may make a bad decision. So that's why we would record in that case, if we bought it from St. Louis, that merchandise inventory had a cost to us of $640. Are you with me? Make sense? Okay. All right, guys, let's call it a day. That's the purchase cycle. Now, next time when we come back, we'll talk about the sales cycle. But I want you to make sure you do your homework. While you're packing up, let me close out with this. This is a chapter that when you watch me do this stuff on the screen, you're going to go, this is easy schmeezy. But when you have to produce these journal entries yourself, it's a lot more challenging. You've got to do your homework. And when it comes closer to the test time, the way to assess if you know what you're doing is not by looking through your notes. It's going to be, can you produce those journal entries with a blank piece of paper? Are you following me? You're going to learn, before this chapter is over, you're going to learn a lot of new accounts, a lot of different transactions. You're going to learn the purchase cycle, the sales cycle. And I see students get these all mixed up on the test. So you have to do your homework, have to practice, okay? See you guys, bye-bye.